My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is special guest Jesse Felder, who I've had on a few months back, and he joined kindly on a sponsored space that we did not too long ago. Jesse, I always appreciate your time. Before we get too deep into anything, just talk about who you are, what you've done, how'd you get involved in markets?
Yeah, I started in markets back in the mid 90s, graduated from college and went to work straight away for Bear Stearns in their LA office. I went to work for a guy there who was essentially kind of running an in-house hedge fund. And we ended up leaving and starting our own hedge fund in LA. We started three funds, a kind of income-based fund, a long-short fund, and a short-only fund, which was fun to try and manage through the dot-com mania. So I was the head trader and assistant portfolio manager of that fund until March of 2000. I quit literally within a few days of the peak of the dot-com mania in March 2000. And since then, I started writing about markets in about 2005 and have just been writing about markets and kind of managing my own money ever since.
I'm sure you've seen those memes, those tweets of that Bloomberg cover photo that came out a while ago that shows a hedge fund perception where it's a guy standing there and it's either, the perception is that it's up and to the right, but in reality, it's, for lack of a better way of saying it, flaccid, given the way the Bloomberg cover looked. I'm curious, Jesse, what is it that's resulted in hedge funds not being able to perform as well as they used to? It's been well documented that alpha, for the most part, is now negative across the board on average for many years, and that wasn't really always the case. What drove kind of, let's call it, the decimation of outperformance by hedge funds?
Well, I think it's two things mainly. One, it has become extremely difficult to sell short really since the financial crisis. Obviously, short sellers did fabulously well through the dot-com bust, and then again during the financial crisis. I think if you had any kind of desire to manage risk, you were successful through those periods. But since the Fed started, printing money in 2008-9, it was, became very difficult to short anything. The rising tide of liquidity has kind of lifted all boats since then. And, I think short sellers have gotten a lot of criticism. My good friend Bill Fleckenstein, I think, was brilliant enough to close his short selling fund in middle of early 2009 when he realized this isn't going to work anymore. And a lot of us tried to continue to sell short and through the last decade. It's been difficult, but the other side of that too is I think you look at a lot of hedge funds, at least in my experience and the way I've tried to manage on the long side, and it typically has a value bent. And so you look at the hedge fund titans of the past, Julian Robertson, that kind of whole lineage of the Tiger, and you have a value bent, and value's been a really difficult thing to pursue for the last 10 years also, as growth has really dominated, and the markets, with this shift to passive investing, a lot of value stocks have been if stocks aren't in an index, there is just not really much money there to flow into these out of favor stocks. And so I think we're now seeing a shift where people are really starting to appreciate again the value of active management, the value of research, the value of pursuing these types of things that have shown their value for over long periods of time. But it's been a long time coming.
So you mentioned Bill Fleckenstein, because I remember him stepping away too, and actually I have him scheduled for a space, I think in 2 weeks, because it seems like he's trying to maybe get back in the game a little bit as far as some notoriety, which, if his track record, is repeatable, that would suggest that there's going to be more alpha opportunities. And that kind of goes to a discussion around the pendulum swing, which you referenced, that there's been so much money that's gone into passive that it's actually made a lot of the active traders no longer be in business, right? And there's always this kind of interesting phenomenon in markets where you need active for passive and passive for active. If everybody goes passive, well, now you don't have as many players in the game. Anomalies get bigger. Pendulum swings back. Suddenly, active makes a comeback. And the value tilt is an interesting one. I want to play with that a little bit, because that makes it seem like the best environments to do short trades in are ones where value is dominated. I want you to talk through that a bit.
Yeah, well, I think, in an environment where rising tide of liquidity is lifting all boats, at least all boats that have index exposure, it makes it really difficult to short, and it makes it really difficult to set yourself apart from the index. And so when you have this shift to, when correlations start to, and disperse a little bit, and you see more dispersion in the markets, I think it's a time to shine for active managers. I mean, just the best example that I can see in the markets over the last 18 months, 2 years, is, back in the fall of 2020, we saw that in the S&P 500, the exposure, the allocation, or the membership of the energy sector within the S&P 500 fell to about 2% of the index. And those stocks were completely left for dead. But anybody, who has an active type of mindset is looking at these things and saying, the capital cycle has made them very attractive. They had 5-6 years of very crimped spending, right? And for commodity type businesses, they're entirely driven by that, right? When you have a bunch of money flowing in, like we saw from 2010 to 2014, and capital's cheap, those companies used all that capital to invest in supply, and the oil price crashes. The 5 years subsequent to that oil price crash, you had, these companies were starved of capital, and ESG magnified that. And so, you could see that these, the stocks were literally trading well below liquidation value. So anybody, kind of looking to energy, there was also a massive amount of insider buying, which is something that I pay very close attention to. When you have, a guy like Harold Hamm, who's stepping up and buying literally hundreds of millions of dollars of his own stock and saying, I'm going to keep buying until the stock price, I don't think the stock price is cheap anymore. It's hard to ignore that. But passive investors are essentially making that bet that, I don't want to bet alongside Harold Hamm, and the like. I want to own the most of things that are the most overvalued, and I want to avoid the things that are most undervalued. That's the nature of market cap weighting. And so I think, this dramatic outperformance of energy over the last 18 months has been a real wake up call to passive investors. And that if you're going to pursue this strategy, one of my favorite quotes is, somebody asked Charlie Munger about passive a couple of years ago, and he said, if you take it to its logical extreme, you get preposterous results. And I think, we haven't taken it to the ultimate extreme of 100% invested in passive, but we did take it to way too far of an extreme, where way too much money, I think, has been put into passive, and it creates these distortions that really create opportunities for people looking to find things that are neglected by the indexes.
The word dispersion's interesting to focus on because there is a school of thought that ETFs basically made everything co-move more similarly. I mean, if you take energy out of the equation this year, clearly, and dispersion is necessary for diversification. Again, if you take out commodities, everything's acted kind of the same this year, right? Whether it's stocks, bonds, your sort of mix of asset classes, which are supposed to have that dispersion, are actually correlated more than ever before, at least for a moment in time. Talk through if you think ETFs have maybe changed some of the market structure here in terms of trying to stock pick, trying to get that dispersion, that alpha, which is elusive for most.
I don't know if like the ETF as a vehicle has created a lot of these problems. I mean, there's a lot of problems I can see from just algorithms. There's been a big push to just algorithmic based trading, and a lot of that's good, but a lot of it can cause problems. Like I do believe what we saw in GameStop and Bed Bath and Beyond, was the crash in those stock prices during the early days of COVID, and then the rebound. All of that extraordinary volatility, I think, was driven by algorithms taken to way too far of an extreme. I mean, as a longtime short seller, I would never even dream of touching something that has 100% of the float sold short or anywhere near it. I mean, I was buying Bed Bath and Beyond, stock 2 years ago, into the COVID crash, because it was essentially trading for, less than book value, and they owned a ton of real estate. And 80% of the float was sold short. So if there was any positive signs at all in that business, to where short sellers had to start covering, you knew the stock price was going to go up 5, 10 fold. And GameStop was even more dramatic. So, and Michael Berry was pretty vocal about that, in the early days of COVID, that, GameStop is extremely cheap stock, cheap for a reason, right? The business is not fantastic, but it gets cheap enough to where it becomes a cigar butt. We're literally trading less than liquidation value, and you have 100% of the float sold short. So I think there's, algorithmic based short selling funds, and I think they're at work in the markets today still, where you see things that are dramatically over shorted, and they use, a trend following technique that doesn't even take into consideration the amount of float sold short or any of these, valuation metrics. They just see they're high volatility and they're in a downtrend, and so we're going to continue to short more and more of it until it goes against us. I think those are the types of things that I see operating in the market. I don't think necessarily ETFs, but passive has, is another algorithm in the markets, as we've seen. I mean, right? It's essentially just money flows in, we buy stocks, and we buy them based on their market cap. So it's been astounding to me to watch a stock like Apple, which I was, buying heavily and writing about on my blog, in the wake of Steve Jobs passing. Stock traded 5 times cash flow. Nobody wanted to own it. And today it trades, if you back out stock-based compensation, it's like 30, 40 times cash flow, and everybody wants to own it. But, you have the algorithm, it's just the company's buyback program, which is just that we're going to buy consistently every day, through, come hell or high water. And passive, it's the biggest stock in the index. So money flows into the indexes. It's all going to flow to Apple. And then you throw in, the crazy call buying thing. And so you get these, stock price extremes that are driven by algorithms. And I think passive is another one of these algorithms that's creating distortions.
So it kind of goes from fooled by randomness to fooled by algos, right? It's kind of, I think, a way to frame it. And speaking about Apple, and you mentioned Jobs' passing. I always had this belief that when Steve Jobs passed, the market needed some new charismatic personality to see as a visionary, and Elon Musk was that. And the narratives then built, and Tesla obviously went, in terms of the stock price, utterly crazy. When you look at some of these mega cap stocks, particularly something like Tesla, do you think that's much more algo, just trend following, than this narrative around retail coming in? Because I have to tell you, I don't quite understand how people think that this is all about diehard Tesla fans pushing the stock up when the market cap is enormous.
Well, I think there's something to do with the call buying frenzy also. Obviously Tesla is insanely priced, but, in Nvidia, I mean, both also, trading 30 times sales, which is, several multiples greater than its peak at the dot-com mania. So, I mean, and Tesla, a lot of people have done a lot of work to demonstrate, it's more valuable than all the other car companies combined, et cetera, et cetera. But when you look at, I mean, even still to this day, the amount of call buying in Tesla's stock is just off the charts. And I think there is a dynamic, and I'm not an options, expert, but there is a dynamic where, we've seen this. I think, I can't remember who it was, but in actually 2020 pre-pandemic, there was an interesting article in Bloomberg about this phenomenon, where a lot of the, Wall Street bets, kind of Reddit type crowds realized that, hey, if we all go in and buy a bunch of calls, right, we're going to push the stock price up, because market makers end up short the calls. And then how do they hedge a short call position? They got to go buy the underlying equity. So with a small amount of capital, you can create a bunch of real cash, demand for the shares in these things. And I think that's one of the main things that's been, so that is pure speculative mania, right? That's you read Manias, Panics, and Crashes, or any of these books about speculative manias in the past, and what we've seen in this call buying friendly is exactly that. Is a speculative mania that's pushed these prices up. Now, I think what makes this one different is, the amount of leverage that's been used, right? I mean, margin debt to GDP is higher than anything we've seen since 1929, since the 1929 peak. But even look back to, to the dot-com mania and things, we didn't have leveraged ETFs like we have today, which, I mean, the amount of money in leveraged ETFs quadrupled from the pre-pandemic. And then obviously call buying went through the roof, billions and billions and billions of dollars of call buying. So the amount of leverage that's been used during this mania is completely off the charts. And it's probably, I think, only begun to be unwound.
I remember I did a space with Gina Martin Adams of Bloomberg, and she noted that point about margin debt, while it's true, it happens at every single new high historically. So to her, it was one of those things where it's not unexpected. I kind of pushed back a little bit, saying yes, but the more leverage you have, the more vulnerable you are to a margin call that dominoes into all kinds of other volatility dynamics in other asset classes. How much of what we've seen this year do you think is due to sort of a margin call that seems to be happening across the board? Because the thing about margin calls in one asset class is that it tends to never really just be isolated to that one asset class.
It's a good point. Margin debt is always, goes higher. And so you have to normalize it somehow, which is why I looked at margin debt to GDP. And, in 2000, it peaked at 3% of GDP. In 2007, pre-financial crisis, it almost got back to 3%. And then pre-pandemic, we got to about almost 3.5%, which to me was another sign that even before the pandemic, the amount of leverage was indicating. So John Kenneth Galbraith is basically called margin debt in his book on 1929, basically the index for the volume of speculation. When you normalize it to GDP, I think that's a way to try and understand how do we compare this to the dot-com mania? How do we compare it? So, we got to almost 4% of GDP early last year. And, that was 30% bigger than what we saw in 2000. And that's normalized. So I do think we are starting to see an unwind. I think that's, in this, but call buying is starting to normalize, but it's still above, the pre-pandemic levels. And we still see money flowing into the ARC Innovation Fund. We still see money flowing into equities. I just tweeted an article from Wall Street Journal this morning showing that only 4% of the money that went into the markets last year has actually been pulled out in withdrawals. And in typical market bottoms, you see, 50, 70, 80% of that money flow back out, 100% during the financial crisis, the previous 12 months inflows. And so we've only seen 4% of that money come back out, tells me that we haven't seen, and everybody's talking about we need to see capitulation, but we haven't really seen that in any respect so far.
So worth noting that there's a lot more hidden leverage than people realize, right? It's not just leverage in terms of how much people are margining to buy up equities, but a lot of these companies are also themselves highly indebted, right? I don't think most people make that connection.
Well, yeah, I mean and that's the cost or the natural result of a 40-year downtrend in interest rates, right? We see government debt to GDP hitting over 100%, and we see corporate leverage. One thing that and now we see consumers putting back on credit card debt. But that's probably one area where leverage isn't as high as other areas. Is we mailed checks to people. And they use that to pay off a lot of debt, and we're talking about student loan forgiveness and these things. But you're right. There is a lot of leverage in the system in terms of corporations, government debt, and investor debt too. Another one I didn't mention is these asset-backed loans, which don't even go into margin debt. So you have high net worth individuals who have, for tax reasons, decided to not sell equities and these types of things, and rather just borrow against it. And that's also been a huge area of business for the major banks. And so yeah, there's more leverage, and I'm mostly worried about the leverage in the financial system, leverage to markets, because I do think margin debt is just representative of a much larger amount of leverage that's out there.
Yeah, and leverage always is driven primarily by recency bias, right? Which creates overconfidence because people then start making money, they lever up, low volatility, and that's sort of the so-called Minsky moment that takes place. Now, you mentioned the 40-year downtrend in rates, and I'm sure similar to me, Jesse, you've heard everybody say, "Oh, this is about to end. This is about to end. This is about to end." And now people are seemingly very confident that it's over, that this trend in yields is now on a permanent basis reversed. But it seems to me that you can't really function as a system if, especially with the amount of leverage we have, if yields keep rising, certainly at this pace, unless growth really does overtake inflation. So let's talk about the bond market here for a moment in terms of if you believe this 40-year downtrend in yields is over or if this is more capitulation. And the reason I say if this is capitulation is you've had negative real yields for a long time, which means bonds have lost money for a lot of people for a while on a real return basis. And typically the end of a bear market is when you have that flush. And what's happened in the bond market to me this year kind of looks like a flush.
And I totally agree. I think, the last couple times we've spoken, I've said, all my indicators suggest we should be seeing a top in yields. The reason or the fact that they've continued higher, I think, is entirely attributable to two things. One, the Fed, lifting its thumb off of the bond market. So finally, interest rates can kind of reprice to figure out where's the natural level that they should be. And, two, the bond market vigilantes are back. I think you can only buy bonds if you believe that, long-term bonds, if rates aren't going to go higher, and if you think that the Fed is going to preserve the purchasing power of the dollar. And so I think with all the signs of recession that are popping up, that I've been writing about for several months now, that buying bonds would be a good bet in that respect. But you also have to have faith in the idea that the Fed is going to do enough to bring inflation back down. Because if inflation stays, even at 5%, right, and you can't buy a 3% yielding 10-year Treasury or 30-year Treasury bond. So I think the fact that rates haven't been listening to fundamentals is just a sign that investors aren't confident in buying them at a 3% yield if the Fed isn't willing to do whatever it takes to bring inflation back down. I do think, when you look at the long-term charts of rates, the 10-year, the 30-year, they've both broken out of their long-term downtrends. To me, that's a clear sign. Paul Tudor Jones has said, when you see price break an important level like that, it's a clear sign that the trend has changed and is going to continue in that direction for some time. Now, I think that's an important long-term signal that the downtrend is over, but that doesn't mean rates are going to continue to power higher. I think, I agree with you, Michael, that I think that, the economy can't handle rates that are much higher than they are today. I think if we saw 4% on the 10 or the 30-year, we'd have people starting to talk about yield curve control again. And I think that discussion is coming at some point. I know you had my friend Tom McClellan on one of these spaces recently, and he's got an interesting indicator where the gold price leads interest rates by, I think, about 20 and a half months, I think is, and so that's actually been a very good signal, leading indicator for rates. It suggests, a top in rates right about now. And that's just, then you look at all the other fundamental, you look at like cyclicals to defensives have, been weak. Small cap relative to large caps have been weak. I mean, a lot of these indicators that suggest rates should be topping right now. So I do think we probably are in maybe a sideways trend for rates, and they could even come back down to test the breakout of that downtrend I was talking about.
So for me, this is the most important question, and as a follow up to that point, which is that if rates have topped, does that mean that treasuries in particular act like the risk off asset? So if yields have topped, do you think the equity market would view that as bullish, or would suddenly then the narrative maybe change to, well, shit, if long duration yields have topped, then this inflation is transitory, and then maybe there's other things to worry about?
If yields top, it's not necessarily a sign that And I think they probably are in making in the process of making a short term top right now. I think the bond market does a better job at forecasting the economy than it does inflation. I think I for inflation I looked at things like the copper price and those types of things, and it's interesting to see with Shanghai reopening again this short term correction in copper and the like could be near an end. And I do think personally I'm in the stagflation camp. I think we're going to see the economy. We're probably already in recession, and inflation's going to remain elevated. The question is, can bonds hedge stocks going forward? And I think if
Which goes back to
inflation's
the dispersion, right? Which goes
yeah,
back to that,
I think if
right?
inflation stays elevated, it's going to be tough to use bonds as that hedge. I go back and forth with trying to trade. I've been trading short Nasdaq for most of this year, just through futures. But the last week or two, I've been trying to switch that and say, hey, maybe buying bonds is the better hedge in the short run. Just because we're getting oversold in stocks and sentiment's getting pretty negative, and sentiment's very negative in bonds, and we could see a rally in the bond market. So, but I don't know if that will act as a hedge to a further decline in stocks, or if stocks and bonds are probably going to rally together.
Yeah, and I've been teasing that out as a series of tweets that I wouldn't be surprised to see yields drop and stocks rally initially, but then yields continue to fall on the long end, maybe, and then stocks go down. In other words, the initial reaction would be a misread by equities, because I keep going back to this point that I don't see how you can have secular inflation when debt is as high as it is and not changing, right? And all the other longer term things are still in play: demographics, technology. I mean, the disinflation deflation argument I don't think really disappeared. It's just on hold for a bit. But I'd like to hear your thoughts on sort of that point.
Today, I'm surprised that people are so quick to dismiss the parallel between today and the early 70s, because the parallel between today and 1973 is very, very close, right? I mean, you had Syria go to war against Israel, and that created the oil embargo that Saudi Arabia, and created an energy crisis. But inflation was already a problem before that, because government spending for the war in Vietnam was so rapid, and so the parallels are so obvious. And in fact, when you look at the 12-month change in the S&P 500, the price pattern is like a 90% correlation to 1973 right now. So, I mean, to me, everything I look at says, hey, this is the what we should be looking at. And so in 73, 74, right, the economy nominal growth, was still remained really high. The economy grew at 8% in 1974 in nominal terms, but inflation rose to 12%. And so in real terms, we had a pretty painful recession. I think that's what we saw in, starting in the first quarter of this year. Real growth was negative. Nominal growth is still really good, but inflation's rising faster. And so I think that's the environment we're in. And I think the forces of inflation, right? The supply chain constraints are kind of a unique compounding factor on top of the underlying inflation. When you have such a shortage of labor as we have right now, that's something that doesn't go away. Wall Street Journal has an article today. Walmart can't hire enough managers at $200,000 a year. They just can't find enough college graduates to come manage a Walmart. And they're paying drivers over 100,000 a year starting pay, and they can't find enough drivers. Those are things that don't go away, and this is something that I'm a big fan of Goodhart and Prodhunt's recent book, The Great Demographic Reversal, because they wrote about and published these things well before the pandemic, that the aging of society creates labor shortages. You're relying on fewer and fewer workers to run a growing economy, and that is naturally inflationary, right? People in the workforce are the productive side of the economy, right? They're producing more than they consume. People who are retired, or children who aren't working yet, the dependents in the economy are subtract from that, they from productivity. They consume more than they produce, and so and they're the inflationary side. So the product, workers are the deflationary side of the economy, and retirees are the inflationary side of the economy because they're consuming more than they produce. And so as societies age, they become more inflationary. This is something the BIS published 5 or 6 years ago, that there's a very high correlation between age dependency ratios and inflation in economies. So the BIS warned that this was going to be a problem well before the pandemic. Now we're seeing it, and it's exacerbated by the pandemic, but it's not going away. The underlying secular forces of inflation are going to remain. And for the Fed to think that, they're going to raise rates to 2.5%, create a soft landing, rein in inflation, it's asinine in my view. We have, the Taylor rule says Fed funds should be 10% today, right? And we're not even at one. That's not how you rein in inflation, especially when you have these secular forces of inflation that are problematic, and they're only being exacerbated by deglobalization and all these other issues. I do think we're already seeing the de-dollarization process get underway, and it's the worst possible timing, right? I mean, we need people to keep money in dollars, and to buy treasuries, and to keep this whole thing going. Our massive trade deficit requires these things, and so with the Fed printing so much money, and the government taking on so much debt, the only way we can really kind of get away with all of this is to have the world's reserve currency. And so, with people, I mean, you had Russia, right, well before the war in Ukraine, divesting dollars, and I think China's been looking at ways to do this, and this is problematic. It's something that, but it's also a slow motion process. As for the idea that there's going to be some other type of currency, I have no way of knowing. I'm a value investor at heart. I just want to find cheap stocks, basically. I study technical analysis and insider activity and all these other things to try to help my probability at, stock picking. But when it comes to these, some of these big macro themes, I think there's really, I pay very close attention to them, but I think there's almost no way to try and anticipate and profit from them. That's why one of the reasons I've stayed away from the crypto space. To me, it's very reminiscent of the dot-com bubble, and looking at things and saying, and trying to pick the winners that were going to come out of that bust. And it was, you look throughout history. 100 years ago, it was the auto bubble, and there were literally hundreds and hundreds and hundreds of auto companies, and trying to pick the winners coming out of that was, it's like buying a lottery ticket. You can buy the stocks of all of them and hope that one of them turns into a 100 bagger or something like that, and more than makes up for all the other losers that go out of business. But that's not the type of investing that I'm interested in. And so when it comes to an alternative currency, for me, when I try and think of, okay, what do I want to use as an alternative currency, I look to gold, and I think that that's the only one that's proven it. It can't be, you can't make more of it. Nobody's figured out how to make produce gold. It has true proven scarcity over long periods of time, and has been money for 5,000 years. So for me, that's the one. And we go through cycles, these sociological cycles, where we screw things up. Okay, we need to come back and create a gold based form of money. And then we print too much money, have to break that new money's linked to gold, or debase it, and somehow, like the Romans did. But we end up realizing that gold is really the only way to create a real stable currency. What crypto and blockchain have, what makes them different than just literally physical gold, in my mind, is that they are a technology. And the lesson of technology, and this is the lesson I think that we're already learning about Bitcoin, is there is no technology in the history of technology that has preserved its value, right? The nature of technology is creative destruction. You create something, and when something new and more efficient comes along, that previous version becomes worthless. And I mean, just think about Windows 95. What's Windows 95 worth today? It's worth nothing. And that's because whenever the new version of Windows comes along, everybody, the previous versions become worth less and less until Microsoft, says these aren't supported anymore, and we literally can't use them anymore. They become worthless. And so I think that's, my friend Eric Townsend and I talked about this a few years ago, and he said, eventually we're going to look at Bitcoin as the MySpace of the cryptocurrency world. And when the Facebook comes along, people are going to say maybe that's Ethereum. And, okay, great. Well, it's much more efficient and these things and doesn't waste as much energy and can process more transactions. Terrific. Well, that means that previous cryptocurrencies have less value because they're less efficient and things. And so that's just my view is that when you have then the nature of technology means that something better is going to come along, and when it does, that new thing is going to have value, but the prior things are going to have less value. We had our own broker dealer in the late 90s, and I had just a handful of retail clients that were trading through me. I had another hedge fund based in New York that was trading through my trading desk. And so, I would see kind of what firsthand, what, were the most popular things. And the idea in the late 90s was that people could quit their jobs, become day traders, and they could probably make 100% a year, something like that, just buying Netscape and these other stocks. And if they couldn't make 100% a year, then it was like, why is it worth my time? We saw a much more extreme version of this. People weren't just buying stocks, they were buying call options that expire in 2 days, right? They were literally on Wednesday buying call options that expire Friday. And, so the amount of leverage being employed, and people think that I'm making 1,000, 10,000 times my money in a matter of days. There were all these, TikToks and things where people were saying, look, if you can just make, 1% a day, every day, you can be a millionaire. And it's like, yeah, if it was that easy, then we'd all be, trillionaires right now. And so I think that the mindset was much more extreme today, and during this latest mania. And I think we're only in the very early innings of it being unwound. Bob Farrell, there was an interesting article in Barron's this weekend with Bob Farrell and his rules, on money management and markets. And when he in the interview he said that he compared also the current stock market to the Nifty 50 era that ended in 1972. And I think that's a very interesting comparison for all these other things that I mentioned with inflation and whatnot. And he said every time you have this, concentration in a number of stocks, it was Nifty 50 stocks in the late 60s, early 70s. It was the dot-com stocks and a handful of really popular blue chips too. I think people forget Coca-Cola stock price got extremely overpriced in the late 90s. But every time it ends in a 10-year period of dramatic underperformance for those stocks. So the idea that we're going to have a 4 or 5 month correction and it's going to be a great time to buy the dip in these things is shows a significant understanding of how these things play out. We can talk about the fundamentals and valuations, but I think that's probably a key component of it too.
I was smiling when you mentioned Bob Farrell, only because those who have seen me talk about this in the past, my father actually worked on his team in the late '80s and had a big influence on his career and by extension my early childhood. So, and Farrell's rules are a must read. And I think one of them is, markets tend to overshoot both ways, right? And it's always tends to be more extreme than you think. Now, I will say to your point, Jesse, I mean, part of the reason why this uneducated speculation got so out of hand was social media algorithms, right? That kept on further entrenching confirmation bias around this idea that the best way to invest to get that 1% is buy the stocks that people are doing memes on, right? And silly kind of things like that. And with hindsight, we're going to probably look back and say this was so obvious that this was a turning point for markets because you saw this type of insanity on the fringe. The question, of course, becomes when does that end? Now, I'll tell you, I don't know if you've been tracking what's going on with Terra Luna, but I'm amazed that with everything that's going on with the crypto crash we just saw, I see the uneducated speculation coming right back in after already a horrendous decline, which makes me think that this isn't over. Talk through that a bit because I don't know, man. This is a really weird environment where it's almost like there has to be so much more pain to teach people a lesson of loss, but they're just so quick to want to buy the dip, and people think a crash is a dip, and it could keep crashing.
Yeah, well, there was a great quote from Dan Loeb in his investor newsletter, or quarterly or annual report that came out for his hedge fund. And he said, one of the biggest mistakes that he's seen investors make is failing to appreciate the change in the underlying environment of the markets. And I think that that's exactly what's going on here. Is people think we're still in a buy the dip environment, and you're absolutely right. I mean, with the sentiment, we're nowhere near the place that would be a long term buy. It's fascinating to me to see everybody in the crypto space, quoting Buffett. Be greedy when others are fearful, and be fearful when others are greedy, because everyone's still being greedy. Right. And so, you don't really see much fear yet when people are, your point about social media too is a really good one. I think when Rana Foroohar, who writes for the Financial Times, in February of 2021, kind of the peak of this meme frenzy, she tweeted that her 12 or 13-year-old son had approached her and asked her for money to start a Robinhood account because he saw a Snapchat story that it was time to buy the dip because stonks only go up. This is something we didn't have right in the dot-com mania. You didn't have 12 and 13-year-olds wanting to open a Robinhood account to buy GameStop. You didn't have this. And so it's so much more extreme. And when you see tons of money still flowing into the ARK Innovation Fund, it's just so obvious to me. And this is the real reason why I started writing about markets in 2005, writing about the real estate bubble. I'm grateful to take time to do this kind of a thing, because the only way you go pour money into the ARK Innovation Fund is if you've never experienced a bear market in your life. Because the idea that what we're seeing right now is fear is ridiculous. Fear is 2012 in the real estate market, when anyone you talk to said, I'll never buy a home ever again as long as I live. The idea of buying real estate was ridiculous, and you could go to auctions and buy a house for cash, literally less than the replacement cost of the house. It was buying stocks in 2009 when literally everybody had finally sold out of everything in their retirement fund, and said, I'll never buy stocks ever again. I'm only going to invest in treasury bills for the rest of my life. That's what fear, feels like. And we're nowhere near that in crypto right now. We're nowhere near that in the stock market right now. And sadly, I think, there's more to come on the downside.
You need a degree of almost investor PTSD, right? Where it's like, I'm just never going to touch this ever again. And that's when it's not just be greedy when others are fearful. It's be greedy when people give up, right? I mean, that's, I think, really kind of the proper way to frame it.
Fed policy, and this is something that it's astounding to me that investors are ignoring, right? The Fed is basically saying we need stock prices to come down more before we're confident that we're going to that we've done enough to rein in inflation, right? They're targeting financial conditions, and a big component of financial conditions is stock prices, corporate spreads, and these types of things. And they're basically saying we haven't done enough yet. And so and I'm not saying the stocks can't rally, right? We had a great rally on Friday, and I think there's possibility they could rally for a few more days. But I do think we're in a sell rally type of market, and the Fed is telling you, yeah, the more the market rallies, the more aggressive we're going to be. It's essentially the opposite of the Fed put right now. And I can't remember, it was Zoltan, I think, put out a piece saying the Fed is in the business of selling calls right now. That they have to, cap the upside, and they have to push stock prices lower to tighten financial conditions enough to make it appear to the world that they've done enough to fight inflation. So yes, it's very difficult to be a value investor, and this is one reason why I don't like the value factor. I'm not a fan of the value factor, in the sense that I want to buy the 10% cheapest stocks in the market today. And the reason I'm not a fan of that is because even that, as my friend John Hussman has pointed out, the cheapest decile in the market recently traded at its highest valuation in history. So it might be cheap relative to the rest of the market, but it's not cheap relative to the last 25 years. And so, that's a very important point. You can go buy the cheapest stocks in the market and still get hammered. I want to buy things that, I think that the most interesting areas in the market to me right now are still the energy sector. The XOP energy ETF trades 4 times cash flow. The only way that would be the right price for that is if you believe oil prices are going back down to, $40, $50 a barrel, and earnings are topping out right now. If you think the energy, oil price is going to stay high for any length of time, then those stocks are still dramatically undervalued. And if you think the oil price is maybe going to go to $200, $300 a barrel, then, those stocks, probably could still go up 5, 10 fold over the next few years. So it really depends on your view of energy. Same thing with the gold miners. I mean, they're trading at significant discounts to their historical valuations. The only way that makes sense is like, buying cyclicals at the top, is if you think earnings are coming back down. If you think the gold price is coming back down to 1,000 an ounce, then yeah, those stocks are cheap for a good reason. But if you think the gold price is going to stay high, or gold price is going to go much higher in the years to come, those stocks are dramatically undervalued. So I think you have to, and those ideas that I have, I think, are confirmed by commitment of traders reports, which show the smart money, hedgers, producers are extremely bullish on these commodities still. And nobody owns oil futures right now, right? The speculators, have are not betting on higher prices. So positioning tells me sentiment's still negative towards both gold and oil prices. They're nowhere near a top, and insiders are still buying these stocks heavily. So, I think to be a value investor in this environment, you have to do old school type of homework in these things. What did Phil Fisher called it? Scuttlebutt. You have to do your homework, and it's not like just buying the value factor and kind of relying on a shift that people are going to shift into these cheaper stocks.
Coming full circle, that kind of goes to the name of the space, the right way to look at stocks. So it sounds to me like, Jesse, that of the kind of main ways of looking at equities, the one that's been least in vogue is about to make a healthy comeback, which is fundamental analysis.
Absolutely. I mean, I think, Warren Buffett said 20 or 25 years ago or something, a long time ago, he said you could never imagine a better advantage in the markets than teaching investors that thinking is a waste of time, right? He said this 25 years ago, that they were teaching the efficient market hypothesis in business school. And essentially that's going to push all institutional investors to say, you know what? This idea of traditional fundamental research doesn't work anymore. So I'm just going to buy the index and not worry about it. But what that does is the more and more people who do that, the more opportunity it creates for the few of us who are still doing, individual stock fundamental research, because there are, and my friend Steve Bregman has done some great research, Horizon Kinetics. If you don't read his work, you're missing out, because he's done some great work on, what is, the opportunities that are created by this push to passive, and some of the greatest opportunities can be found are in these areas that are outside the purview of the indexes, that are literally left for dead. There's no money being allocated to these things anymore, and that's where the opportunity is.
In addition to missing out on that, everyone here is missing out if you're not already subscribed to Jesse's work and research with the Felder report. So I think that's a good place to end it. Everybody, as always, thank you for joining and attending these spaces. I'm doing one more tonight at 7 Eastern with John Rogue, 7 p.m. Eastern. So stay tuned for that. Jesse, I always appreciate your knowledge, the way that you frame things. I find myself often nodding when I listen to you. Everything that you said is spot on, and at the end of the day, I keep going back to what I said before. Nobody can predict the future. It's all about conditions and probabilities. And I think the way that you laid out the conditions and probabilities is hopefully will be helpful to those that join. Thank you, Jesse. I appreciate it.
Thank you.